You want to know. What are the best stocks to buy now? I've got 7 stocks to buy right now, according to Seeking Alpha. Let's go. Today, I'm using Seeking Alpha stock screeners. So from the home screen, you go down to this tab here. Of course, click on stock screener, and then we're going to scroll down to top growth stocks. Once in here, we're going to go to advanced filters. I want to change the sector and industry, hit done. Go to edit filters. I'm looking for growth in tech. So we're going to click information technology. We're going to change this market cap from $1 billion to $10 billion. We're going to leave that quant rating as is, and we're going to take the growth down to A-. And you can see the first stock on the list, not McLovin, but AppLovin.
Wait, you changed your name to McLovin? McLovin?
So AppLovin, ticker APP, market cap is $90 billion. This has 115% forward earnings per share growth. It has a PE forward of 40, so it's not cheap, but it does have some solid growth. Headquartered in Palo Alto, California, so think digital advertising and mobile gaming. 2 primary business segments, advertising and apps. AppLovin is recognized for its innovative AI-powered advertising solutions, which include app discovery for user acquisition, max and app bidding, and adjust for analytics and measurement. Manages a portfolio of over 200 free-to-play mobile games. It's showing the competition here is Meta, Alphabet, and Unity, but I want to talk about Trade Desk, so stay tuned for that. Now, don't be confused with Axon, the taser company, but Axon Engine. This is the company's AI solution that enables the ability to deliver personalized advertising experiences. So growth in A, profitability A+, momentum A+, valuations a D, but recently had year-over-year EPS growth of 363%. That's far exceeding the sector's only 9%. Additionally, forward revenue growth of 29% is significantly above the average, which is 7%. This is the most recent shareholder letter from the CEO. So in 2025, looking to advance models, personalized ad experiences, automating dashboard. This is the big one, number 5, exploring CTV advertising. While it's in early stages, we believe there's significant potential in applying our target technology to connective TV. This is part of the reason why the Trade Desk stock is down. A lot of people believe that AppLovin is going to be a competitor against the Trade Desk when you think of CTV. I think there's room for both, and I do own the Trade Desk. These metrics are quite amazing. 75% gross profit margin. You've got that 43% growth with 28.47% forward revenue growth. The valuation, it's not cheap, but it's growing into itself. So a forward gap PE of 40. And you can see it's been on a tear. The last year, it's up 300%. Year to date, the stock is down 15%. You can see the 52-week high was $5.25. 52-week low, $60.67. The year-to-date low was around $238. And you can see in real time, it's down about 20% year to date. So this stock ripped from March 2023. It was under $12 a share, all the way up to $525 a share. Now the stock could certainly go lower, but it's been a market leader and it really has had rocket fuel. So when the market starts to have any green shoots at all, this stock just rips up. I would love to buy this stock under $200 a share, but it doesn't seem like that's going to happen. So when you're thinking of NASDAQ stocks and stocks that have potential to grow rapidly from here, this is definitely one that should fit your bill. But it's always hard to buy these kind of stocks when they rip so much. I mean, even from here, you're talking May of 2024, it was a $65 stock, ripped all the way up to $525. So massive returns over a couple of years. I personally don't own the stock. It is on my watch list, and it's number 1 on the Seeking Alpha stock screener for best stocks to buy. Now, of course, guys, you don't buy a stock just because the stock screener says it's a good buy. It's really there to give you ideas to explore, go do your own homework, make your own decisions based on your own blueprint, your risk tolerance, and so on. Number 2, we've talked about plenty of times on the channel. This is the ultimate pick and shovel, not only for AI, but really every secular growth trend imaginable. Companies like Nvidia, Apple, Tesla, and more can't build the chips they need without this foundry. TSM, Taiwan Semiconductor, 90% of the world's advanced chips come out of Taiwan. The stock is down about 15% year to date. You can see it's a $700 billion market cap, $709 billion. The forward PE ratio is 18.3. It does pay that dividend yield of 1.57%, which is greater than the S&P 500. Profitability A+ with a 56% gross profit margin TTM. That growth is really solid, 33%. Forward revenue growth about 25%. Valuation wise, it's not crazy expensive. 18.05, that's a forward PE ratio, and that peg gap TTM is only a 0.5, so it's growing into itself nicely. So of course TSM, part of the reason that the stock isn't higher is because of that macro and that geopolitical risk. This stock was under $60 back in the fall of 2022, and it ripped to $226.40. So you can see it had a huge air air pocket from that 226. This red line is the trend line. Most recently, it bounced right under this S1 Fibonacci of 160 bucks. Now the S2 is 154.70. The S3 support 3 is 145.15. But we are under the 200-day, the 100-day, and the 50-day simple moving average. And valuation-wise, fundamentally, it's not a crazy expensive stock or anything. So I like this stock a lot, like 175 or less DCA. I do own this now in the community portfolio. And I've been dollar cost averaging and buying this aggressively in that portfolio. It's about 3.5% of the portfolio right now. So number 3, and a reminder, guys, this is from Seeking Alpha, the stock screener. This is Wipro Limited, ticker is WIT. Now, this is technically a penny stock. Anything under $5 is a penny stock. It's trading at $3.06 right now. It is paying a dividend currently of 2.25%. It's down about 14% year to date, and it's a $32 billion market cap. This is headquartered in India, and it's a leading global information technology, consulting, and business process services company. So it's going to compete against companies like Infosys, Accenture, and Cognizant. It's trading right around the sector median of 20 for the PE ratio of 21. Net income margin is 14%, which is significantly higher than the sector's 4% average. So you have an A- on the profitability. The growth is an A, but it actually has negative forward revenue growth. That PE gap forward is a 21.62. So this was a $2 stock just back in 2023. It ripped to $3.79 and it's pulled back to about $3 a share. This S1 Fibonacci is 298, S2 is 289, S3 is 275. So it certainly could go a little bit lower. Just full disclosure, guys, I am not buying this stock, but it is number 3 on the Seeking Alpha list. Okay, so the last stock I said I wouldn't buy, I want to give you a stock that I would buy. This is from my list, not from the Seeking Alpha list, and that's going to be Nvidia. Profitability, really strong here, A+. One thing to note, as these profit margins come down, it's going to put pressure on the stock. It's part of the reason why the stock is down now. And it feels like a lot of people just don't believe that AI is a thing anymore, but I'm telling you that this sentiment is way overdone. The growth on this, 114%, forward revenue growth, 60%. Valuation, this is one of the cheapest valuations you've seen in the stock in many years. A forward gap PE of a 25. So it's down about 18.75% year to date. It was $153.13 at the high. Most recently here, Nvidia basically double tested about $105 a share. You can see 104.77. We're trading at 109 right now, and I'm still confident that this stock will be 165 to 175 later this year, second half of 2025. If you want to know more about Nvidia, I just did a highlight video of GTC. Definitely check that video out after this one. If I didn't own Nvidia stock, I'd be buying it at $109 a share. I've been long since 2017, and it's about 13% of my portfolio. I'm not currently adding. The next one is Samsara, ticker IoT. This is going to be a software as a service or a SaaS company headquartered in San Francisco, founded in 2015. Its core offering is the Connected Operations Cloud that integrates data from Internet of Things devices to deliver actionable insights, enhance safety, efficiency, and sustainability across various industries. So this is video-based safety, vehicle telematics, equipment monitoring, site visibility, and more. These applications serve industries like transportation, logistics, construction, manufacturing, public services, and more. Samsara is building one of the world's largest operational data sets. And according to them, 14 trillion plus data points. That's 50% year-over-year growth. They're telling us they prevented over 250,000 accidents, 300 million workflows digitized, and 3 billion pounds of CO2 saved. Unleashing the age of intelligence, maintenance, training, AI detections, workflows, compliance, safety. Let's look at the cloud-specific metrics that we use for these SaaS companies. The EV NTM revenue is a 14x. Now that's going to be the 8th highest, but for example, Palantir is about a 56x. Cloudflare is a 19x, CrowdStrike 18x, and so on. LTM rule of 40, 42%. Of course, we want over 40%. Free cash flow, 9%. In the most recent quarter, added 1,000 new core customers, and 14 of the top 20 customers expanded. So they're doing a land and expand model. In 2022, the stock was under $10 a share, rocketed up to $61.90. Now, most recently, it got to $32.97. I had a limit order in for $29.97, so I just missed it. Now it's $38. I really prefer this stock $30 or less, but you might not get that opportunity. You can see the S2 is $30.29. The S3 Fibonacci is $24.30. So it is possible you could get 25 to 30, but something catastrophic is going to have to happen with earnings miss or the market tanking more or something. I do like this company. It's just been expensive and hard to chase for a long time, but definitely check it out. Ticker's IoT. This next stock is super interesting. I actually just started buying this as spec in the community portfolio, but I encourage you to do your own homework before you buy this stock. So you can see the company's been around for a while, since 1971, 26,000 employees, 3,100 plus patents. The core foundation of what Coherent does is about photons. The CEO came from companies like AMD, Broadcom, Intel, and more. 3 applications of the photon. One is for AI data centers, another is for lasers, and the third is bouncing photons to measure or sense something. I believe that photon technology has tremendous potential over the next decade. You see, photon or light can replace a lot of those rare earth materials like copper. Not only is it sustainable and generally less expensive, it's also a lot faster. At the same time, being more efficient, and as you guys know, electricity demands are a big issue. Most recently, the data center revenue grew by about 80% year over year. But what I want you to grasp from this company, what it's all about, is in the future you're gonna see more optical versus electrical, and this company is very well positioned to benefit. So what's really interesting about this, we're talking about a $10 billion market cap, and it has $4.7 billion of revenue in FY 2024. The 3 primary segments here: lasers, 29%, materials, 22%, networking, a lot of that's going to be data center, 49%. And within the markets, you have communications, it's about half the business, industrial, 36%, and then electronics and instrumentation are about 8% each. It's mostly in North America, 56%, but does have business in Europe, 13% exposure to China, and another 13% in Korea and Japan. Now take these slides with a grain of salt, but Coherent is telling you that their 4 attractive growth markets have an aggregate TAM of $64 billion. And they're expecting a 14% 5-year CAGR, compound annual growth rate, between 2023 and 2028. So industrials are going to grow a little bit slower, about 9%, but the TAM is pretty large, 22 billion. Communications is the largest TAM at 23 billion with a 14% growth. Electronics, 14 billion, 20%. And you can see instrumentation, 5 billion, 8%. Now the instrumentation part is really interesting. So you can use Coherent's applications for things like high-end microscopes for Alzheimer's research and more. We always talk about investing in growth trends, and these slides help a lot. So megatrends here: gigafactories for EV battery processing, advanced medical devices, additive manufacturing. This is industrial. And you can see in the middle here, it's going to show you the different products that meet these demands. The company has over 50 years of experience in laser technology. Communications, both datacom as well as telecom. So this is going to include artificial intelligence. For electronics, advanced sensors, AR, VR, wearables such as health monitors and watches. Automotive, where you're going to need a lot of automotive sensing. And we talked about those microscopes, but really smart healthcare, the evolution of that. The gross profit margins aren't nearly as high for this, about 33%. You can see the profitability grade is a C+. The growth is an A, and you can see that forward revenue growth is slowing down a little bit. Now, valuation is really interesting on this because you have a non-GAAP TTM PE ratio of 23. The forward is 18.84, but we want to use that gap when we can. So it doesn't have a TTM, but it has a forward PE gap of 64.94. Now the PEG ratio, that forward PEG, is 0.41 at A+, so it's growing into itself nicely. And I think the most impressive metric here is the price of sales. The forward is only 1.77. Again, this is a $10 billion market cap, and it brought in $4.7 billion of revenue last year. So like all the stocks we're going to talk about today, of course, they can go lower. This was a $26 stock, ripped up to $113. Now it's back at 63. So this is a significant drop, of course, from this $113 high, but you do have a Fibonacci S2 that's a little lower, around $57, $58, and the S3 is closer to $50 a share. I'd love to see this stock 50 to 55. I did buy some just as a starter position, and remember, it's spec only in the community portfolio. Next, we have Seagate Technology. The ticker is STX. You can see the stock is down about 8% over the past year. It does have 8.87% short interest, so that's something to keep in mind. Market cap is just under $18 billion. So of course, with Seagate, you're thinking about hardware, storage, and that's going to have lower profit margins, about 32%. The growth is pretty solid, has an A+ rating on Seeking Alpha, and the valuation I think is attractive. The forward gap PE is a 13.7, forward price of sales 2.01. Now, I've been buying this stock in the new dividend portfolio. I just started a portfolio this year. It has over $100,000 in it. It does have a B+ dividend safety. The dividend growth is an A+, dividend yield is an A-. The consistency is a C, and that's because it's only been growing for about a year, and that 5-year growth rate's only 2%. I'd like to see that higher, but it does have attractive dividend yield at 3.39%, and I think fundamentally, it's undervalued. Now, of course, one big question mark here is tariffs and how's it going to impact a company like Seagate. So it certainly could go lower. And if you look at the technicals, it is fairly weak. It shows an S1 here of 82.55, S2 of 77.57, and S3 of 69.57. Now, this stock ripped from the lows in fall of 2022 at $47 a share all the way up to $115. I do like this stock, $85 or less DCA. The lower the better, because if you get something like $69, you're going to have a 4%, 4.5% dividend yield. This stock is not for every portfolio, but I think it's attractive, and I like that 3.4% dividend yield. The last pick is Trimble, ticker TRMB. This is headquartered in Colorado. It's been around since 1978. Offers a diversified portfolio of solutions across various industries: architecture, engineering, construction, agricultural, transportation, and more. The company is known for its integration of sensors, software, hardware, and data analytics. Attractive profitability, 67.69% gross profit margin TTM. The growth is actually showing negative, but again, this is the Seeking Alpha list. Valuation, forward gap PE ratio, 37.63. When you use the non-GAAP, it's closer to 23. It doesn't pay a dividend yield. It has a $16.14 billion market cap. In November of 2023, it was less than $40 a share, almost doubled to $77.78. You can see it's pulled back to the S1 around that 200-day simple moving average. It's trading around $65. It could go lower. The S3 is $58.20. I'm not buying this stock, but it is number 7 on that Seeking Alpha screener. If you're new here and you like videos like this, make sure you subscribe and click that bell to get notifications. If this video is helpful, return the favor, drop me a like, drop me a comment. Have a great rest of your day. Take care.